Welcome to the deep dive. We're here to take those complex, maybe sometimes overlooked parts of the economy and really break them down into essential knowledge for you.
That's the goal.
And today we're digging into something incredibly fundamental, maybe even a bit unglamorous: construction aggregates. We're talking crushed stone, sand, gravel, the absolute
It
basics.
sounds simple, but it's literally the foundation for, well, everything. It's this low-value, incredibly high-volume commodity that underpins the entire U.S. economy.
Right, you can't build roads, bridges, factories, houses, nothing without it.
Exactly. A nation's economic strength is often tied to its
Yeah.
infrastructure,
Yeah.
and every single piece of that starts with aggregates.
And if you're talking aggregates in the US, you inevitably land on the biggest, most specialized player out there, Vulcan Materials Company, ticker VMC.
They're the giant in the field.
Okay, so let's unpack this. VMC. It sounds like a straightforward business digging up rocks, but their strategy, their whole playbook is actually really sophisticated.
It absolutely is. And that's our mission today for you. We're going deep into VMC, looking at their structural competitive advantages, their financial muscle, and, crucially, why they seem perfectly set up to benefit from that massive $1.2 trillion Infrastructure Investment and Jobs Act.
The IIJA, we'll be hearing a lot about that, I imagine.
Definitely. So we've pulled together insights from their financial reports, investor calls, industry data, basically giving you a comprehensive picture through mid-2025. We want to show you how this seemingly simple commodity business built itself into a real market powerhouse.
It's less about just selling tons of rock and more a masterclass in, monetizing geology and discipline.
That sums it up pretty well. Operational discipline is key.
All right, let's start at the heart of it, the business model. For VMC, it seems like everything really centers on their aggregates segment.
That's the absolute core. It's the profit engine. If you look at fiscal year 2024, aggregates brought in about 74.4% of their total sales.
Wow, nearly three-quarters.
And an even bigger chunk of their operating profit, actually. Their scale is just immense. They're running over 300 production sites, mostly quarries, digging up high-quality stone, sand, and gravel.
And strategically located, I assume?
Critically so. Near population centers, near where the demand is, that location piece is vital.
Which brings us to maybe the most defining thing about VMC, their reserves. This isn't just about having enough rock for next quarter. This is like a century-long view.
Exactly. You've hit on something fundamental. They control an estimated 16.5 billion tons of proven and probable reserves.
16.5 billion tons. That's hard to even visualize.
It's staggering. Think of standard dump trucks lined up end to end carrying all that material. You'd circle the earth hundreds of times. This guarantees their supply long, long into the future. It's a core part of their value.
And I've read that those reserves are often considered an undervalued asset on the balance sheet, right? Because they're essentially irreplaceable.
Very much so. It's incredibly difficult to put a current market price on rock that you won't dig up for 50 or 100 years. But its strategic value is immense. It underpins all their future potential cash flow.
Okay, so having the rock is step one, but you mentioned location. That leads to this idea of the economics of proximity. This is their big competitive mode, isn't it?
It's absolutely central to their advantage. Why does a basic commodity like rock depend so much on where it is?
Because it's heavy and cheap.
Precisely. Aggregates have an extremely low value-to-weight ratio. I mean, the rock itself isn't worth much per pound. So the cost of moving it becomes the dominant factor really quickly.
Like that pizza delivery analogy you mentioned earlier.
Exactly. If you have to truck crushed stone, sand, or gravel much further than, say, 50 or 60 miles, the cost of fuel, the driver's time, the wear and tear on the truck,
Yeah.
it just eats up any potential profit. It becomes uneconomical.
So that naturally insulates them from, cheap imports. You can't ship stone from overseas and compete?
Not a chance. The transport costs would be astronomical. It means competition in this industry is intensely local. It has to be.
Which forces VMC's strategy towards dominating those local markets.
Yes. Their whole approach is about building density and achieving localized market power. The data shows they aim for, and usually get, the number 1 or number 2 position in 90% of the specific local markets where they operate.
90%, that's dominance.
It is. And that density directly translates into pricing power. If you're the primary reliable supplier in a tight radius, well, you have a lot more say with the price.
Okay, so proximity is moat number 1. What's the other big barrier? You mentioned permitting.
Permitting. This is arguably even more powerful today. It's the regulatory wall that protects their existing, profitable operations from new competition popping up next door.
Because opening a new quarry is hard.
Extremely hard, especially anywhere near a populated area. Think about it. First, you need the right geology. Not just any rock will do. Second, you need huge amounts of capital for the land and the heavy equipment. But the biggest hurdle by far is getting the permits.
Zoning, environmental approval.
All of it. It's a complex, incredibly lengthy, and often very contentious process. You face massive local opposition, the whole NMBY thing, not in my backyard.
Right. Nobody wants a giant quarry opening up near their town.
So you could spend years, maybe even a decade, and millions of dollars on geological surveys, environmental studies, legal challenges, and still get denied.
Wow.
Which means VMC's existing quarries, the ones that are already permitted, many with decades, even 100 years of supply approved, they become incredibly valuable, almost irreplaceable assets.
So when VMC buys another company, they're not just buying the rock in the ground.
They're buying the permit. They're buying decades of secured regulatory approval. That's the truly scarce resource they're often acquiring. It's a massive defense against new entrants.
Got it. Okay, so they've got the rock, the location, the permits, but they don't stop there. Let's talk about their downstream integration. They sell more than just aggregates.
That's right. They look at the whole value chain. Beyond aggregates, they have two other key segments: asphalt, which was about 16.8% of their 2024 sales, and ready-mix concrete, about 8.8%.
So smaller pieces, but still significant.
Yes, and strategically important, especially in high-growth markets like Texas, California, Florida, the Carolinas, the Sun Belt, basically.
Is the main idea just to diversify profits, or is there more to it?
Profit diversification is part of it, sure. They expect those downstream businesses to generate good cash flow, maybe around $360 million in cash gross profit in 2025, based on guidance.
Yeah.
But the primary purpose is strategic.
How so?
These asphalt and concrete plants act as a captive demand channel for VMC's own high-margin aggregates.
Like owning the farm and the restaurant that uses the produce.
Exactly like that. They guarantee a certain amount of volume for their core, most profitable product, the aggregates, flows into their own downstream operations before it even hits the open market.
Yeah.
It secures reliable demand and locks in market share for the stone.
And then they profit again when they sell the asphalt or concrete.
Precisely. It's a smart, integrated strategy. It pulls their high-margin product through the system and gives them another layer of profitability. It's a significant edge over competitors who only sell aggregates.
Okay, moving from those sort of structural advantages, the moats, to how they actually run the business day to day. Management talks a lot about the Vulcan way. What exactly is that?
The Vulcan way is their internal framework, almost a philosophy, covering both commercial and operational practices. It's all about driving consistent, compounding profitability, even when the broader economy is maybe not cooperating.
So it's about controlling what they can control internally.
That's the essence of it. They don't just ride the economic waves. They try to actively manage their own performance through disciplined execution.
Let's break it down. Starting with the commercial side, the Vulcan way of selling. How do you take something as basic as rock and sell it like a premium value-added solution? Because that seems to be the goal.
It is. You shift the focus from just price per ton to the total value proposition for the customer, primarily contractors. You focus on things like reliability, consistency, logistics, ease of doing business, reduce their risk.
And technology plays a role here. I saw mentions of a customer portal, My Vulcan.
Yeah, My Vulcan is a key tool. It's more than just an online order form. It gives customers real-time visibility into orders, delivery tracking, quality specs, forecasts. It simplifies their life.
Making it stickier to be a Vulcan customer.
Exactly. By improving that whole experience, making ordering easy, guaranteeing on-time delivery of the right spec material, they increase the switching costs for that contractor.
What's fascinating here is how they use sophisticated logistics and reliability to differentiate what is fundamentally a commodity product. If you're a contractor pouring concrete for critical bridge support, you absolutely cannot afford a late shipment or inconsistent quality aggregates.
Absolutely critical. A delay costs them enormous amounts of money in crew time and project deadlines.
So VMC's scale, their private rail network, their trucking fleet, which handles nearly half their shipments, becomes a guarantee. You pay a premium, maybe, but you're buying certainty. You're buying reliability, not just stone.
That's the value proposition. Smaller competitors often just can't match that level of logistical sophistication or the sheer capital investment required to guarantee that reliability at scale.
Okay, so that's the selling side. What about the operational side, the Vulcan way of operating? This must be about efficiency at the quarry itself.
Precisely. It's about digging up and processing that rock as efficiently and cost-effectively as possible. Rigorous cost control is paramount.
How do they manage that across hundreds of different sites?
They rely heavily on technology here, too, particularly something called the process intelligence system.
Process intelligence, what does that do?
Think of it as real-time diagnostics and prescriptive management for all their crushing and screening equipment, the heart of the quarry operation. It measures performance constantly, second by second.
So it can spot problems brewing.
Instantly.
Yeah.
If a crusher motor starts drawing too much power, indicating a potential failure, or if the flow of material through a screening plant slows down, suggesting a blockage or inefficiency, the system flags it immediately for the local managers.
Allowing them to fix things before they break down or cause major delays.
Exactly. It shifts maintenance from being reactive, fixing broken things, to being predictive and preventative. It helps them fine-tune operations in real time, keeping throughput high, costs low, and product quality consistent.
That sounds like the kind of discipline needed to handle unexpected issues, like, say, bad weather impacting production. Management mentioned record rainfall hitting volume in Q2 2025.
Right. And having that operational discipline, that real-time monitoring, helps them manage those disruptions more effectively, control the costs associated with them, and ramp back up quickly. They're constantly fighting that incremental cost creep at every stage.
Okay, so this intense focus internally, value-based selling, operational efficiency. What's the proof? Does the Vulcan way actually deliver consistently better results, especially through economic ups and downs?
The numbers tell the story. Look at their unit profitability in aggregates. VMC achieved 11 straight quarters of year-over-year growth in that metric, right through the end of 2024.
11 quarters in a row.
11 quarters. That kind of consistent margin expansion in a notoriously cyclical industry like construction materials is, well, it's highly unusual. It's strong evidence that their success isn't just luck or timing the market cycle. It's driven by this repeatable, internal process that focuses relentlessly on the profitability of each ton they sell.
But I have to push back a bit here. If they're always prioritizing margin over volume, getting more profit per ton, aren't they potentially losing ground? Especially when the overall industry volume is still, 23% below the 2006 peak? Couldn't rivals like Martin Marietta just grab that volume, grab that market share? What's the risk of damaging customer relationships for short-term profit?
That's the absolute key strategic tension, and it's a fair question for anyone looking at the company. Management's perspective, or bet, seems to be that the market will ultimately value their reliability and superior locations, especially with the massive IIJA demand coming online.
So they believe the volume will come eventually without needing to sacrifice the price gains they've made.
That seems to be the strategy. Build the highest possible margin structure now, condition the market to accept premium pricing for premium service, so that when that big wave of infrastructure volume does hit, which they clearly anticipate, that high margin per ton will compound into explosive earnings growth.
It's a bold strategy. Hold the line on price, knowing the volume wave is building.
It requires confidence in their market position and in the IIJA timeline, definitely.
Okay, let's widen the lens now to the overall market environment, because the last couple of years, say 2023 through mid-2025, have been really defined by these powerful, conflicting forces, haven't they? Big economic headwinds hitting up against this massive infrastructure tailwind.
Absolutely. It's been described as a great transition or a passing of the baton period for companies like VMC. You always have to remember this industry is deeply cyclical. It's tied to GDP growth, overall construction activity, and maybe most importantly, interest rates.
Let's tackle the headwinds first. Rising interest rates since 2022 seem like the biggest cloud.
Without a doubt. The Fed's aggressive rate hikes dramatically increased the cost of borrowing money for developers. It tightened up lending standards, banks got more cautious, and crucially, it hammered housing affordability.
And residential construction is a decent chunk of VMC's business, right?
Yeah. Traditionally, around 20% of their shipment volume.
Yeah.
So when mortgage rates shot up and housing starts cooled off, that directly impacted a significant part of their demand. That sector has been weak.
Plus, they were dealing with inflation on their own side. Fuel, labor, parts, equipment, everything costing more.
Right. Broad-based inflation hit their input costs hard. So you had softening demand in one key segment, rising costs. Normally, that's a recipe for margin compression, squeezed profits.
But that's not what happened with VMC. This is where their pricing power really showed up.
It really did. Their ability to push through price increases that didn't just offset the cost inflation but actually exceeded it. That's the single most impressive part of their performance during this period.
Let's see the numbers on that.
Okay, look at Q4 2024. Their freight-adjusted price for aggregates went up 11% compared to the year before.
11%. That's strong.
But their unit cash cost of producing those aggregates only went up 5%.
Wow. So they expanded their margin per ton quite significantly, even with those cost pressures.
Exactly. They grew the spread. And that trend actually got even better moving into 2025. In the second quarter of 2025, they reported an 8% increase in their mix-adjusted pricing.
Okay, still strong. And costs.
Unit cash cost increase was almost flat, just 1%.
Just 1%. So 8% price increase against a 1% cost increase.
Yeah. That demonstrates extraordinary pricing power. It suggests they aren't just passing along costs, they're able to command a premium because of their market position and reliability, even in a mixed demand environment. That margin expansion is what kept their earnings growing despite softer overall volumes.
Okay, that pricing resilience is key.
Yep.
Now, let's flip to the tailwinds. The public sector roads, bridges, infrastructure, that's usually around 40% of their shipments, you said?
Roughly, yes. And critically, public sector spending tends to be more stable than private construction, less sensitive to interest rates once it's funded.
And the big story here is the Infrastructure Investment and Jobs Act, the IIJA.
That's the $1.2 trillion catalyst everyone's focused on. This provides a multi-year federally funded floor for demand. And, importantly, that federal money isn't directly impacted by rising interest rates in the same way private development loans are.
How much of that is relevant to VMC?
Within that huge bill, there's about $110 billion specifically earmarked for roads, bridges, and major projects. These are incredibly aggregates-intensive projects. Lots of concrete, lots of asphalt base.
And VMC's footprint seems almost perfectly designed to capture this spending.
The alignment is remarkable. About 67%, two-thirds, of the IIJA highway formula funds, the money distributed directly to states based on need, are going to states where Vulcan has a significant established presence.
We're talking Florida, Texas, California, Georgia, the Carolinas.
Exactly. High-growth states where they are already number 1 or 2. And this isn't just some theoretical future benefit anymore. The leading indicators are already turning positive. By mid-2025, if you looked at the trailing 12 months of highway contract awards in VMC's key states, they were up over 20%.
So the money is flowing, the contracts are being signed, the work is starting.
Yes. The planning and bidding phase is largely done for the early waves. Now the actual digging and pouring begins. That translates directly into demand for VMC's products.
Beyond highways, though, are there other, maybe newer demand drivers emerging?
Absolutely. And this is where it gets really interesting. VMC is benefiting from secular trends that you might not immediately connect with a basic materials company.
Like what?
The biggest one right now is data centers. The explosion in cloud computing, AI, data storage. It's fueling a construction boom in massive data center campuses.
And those require a lot of concrete and foundations.
Huge amounts.
Yeah.
And guess what? VMC's footprint, again, lines up perfectly. Nearly 80% of the planned data center construction activity in the U.S. is located within about 30 miles of an existing Vulcan quarry or distribution yard.
30 miles. That's
Yeah.
well within that economic shipping radius. So they become the logical, maybe only supplier for many of these huge projects.
For the sheer volume required. Very likely.
Yeah.
That proximity advantage is critical again.
Okay, data centers. Anything else?
It ties into the broader theme of industrial onshoring or reshoring. Policies like the Cheech-Epi Act are encouraging the construction of huge new manufacturing plants, semiconductor fabs, battery factories, etc.
More big construction projects.
Exactly.
Yeah.
And all these new facilities, plus the energy-hungry data centers, require significant upgrades to the power grid. New power generation plants, new transmission lines, all needing concrete, foundations, access roads. It all adds up to more aggregate demand.
So this raises an important question. We really are seeing this passing of the baton, aren't we? The infrastructure spending, the data centers, the industrial build-out. That demand seems to be ramping up just as the housing market softened due to interest rates. How smooth has that handoff actually been?
Well, the financials suggest it's been remarkably smooth in terms of profit, but that's almost entirely thanks to that aggressive pricing strategy we talked about. They've managed to grow earnings by substituting margin expansion for the lost residential volume, essentially.
So the higher profit per ton offset the fewer tons sold.
Precisely. And the key thing enabling that strategy is the visibility from the IIJA. Knowing that billions in funded projects are already locked in for the next several years gives management the confidence to hold firm on price, even if it means letting some lower-margin residential volume go for a quarter or two. They believe the big public wave is coming, and they want to meet it with the highest possible unit profitability already established.
Confidence in the long-term public volume underpins the near-term premium pricing strategy.
Got it. Okay, let's dive directly into those financials then, because the result of this price over volume strategy really stands out when you look at their income statement. It's kind of counterintuitive.
It really is, and it's probably the single most important takeaway for understanding VMC right now. Look at fiscal year 2024. Their total revenues actually declined. They came in at $7.42 billion, down from $7.78 billion the year before.
Lower revenue. Why?
Directly because shipment volumes fell. Aggregate shipments were down 6.3% year over year. And remember, overall industry volumes are still way below that 2006 peak, about 23% lower. So normally, lower volume, lower revenue. You'd expect lower profits, right? Especially in a commodity business.
You absolutely would. But that's where the VMC story diverges. Despite selling less rock and bringing in less total revenue, their net earnings actually increased. They rose to $911.9 million in 2024, up slightly from $900.5 million in 2023.
Wait, how? Lower revenue, higher profit?
Margin expansion, pure and simple. They made so much more money on each ton they sold that it completely offset the impact of selling fewer tons. The entire earnings growth came from widening that gap between price and cost.
So the key metric to watch isn't total revenue or even total volume, it's the profitability per ton.
Exactly. That's the metric that encapsulates their strategy and justifies, in management's view, their premium valuation. The specific number to focus on is aggregates cash gross profit per ton.
Okay, cash gross profit per ton, what did that do?
In 2024, it grew by a very strong 12% compared to 2023, hitting $10.61 per ton.
12% growth in unit profitability. That's impressive. Did that momentum carry into 2025?
It actually accelerated. By the end of the second quarter of 2025, that key metric had climbed further to $11.88 per ton.
$11.88.
Wow. And management was explicitly guiding investors to expect another year of double-digit growth in this specific metric for the full year 2025. It just underscores their relentless focus on value over volume. Maximize the profit on every single ton first.
It does seem, though, that eventually, to get really significant earnings growth, you need that volume to come back too, right? Since it's still so far below peak levels.
Absolutely. The margin expansion story is powerful, but the ultimate upside comes when you combine these record-high unit profits with a significant recovery in volume, driven by IIJA and potentially a rebound in private construction later on. That's the bull case scenario. But for now, the margin focus is protecting and growing earnings effectively.
Okay, makes sense. Now what about the balance sheet? In a heavy cyclical industry like this, financial strength must be crucial.
Paramount. You need resilience to ride out downturns and the firepower to invest for growth. VMC looks exceptionally strong here.
How so? Cash flow.
Very strong cash generation. They produced $1.4 billion in operating cash flow in 2024. And by mid-2025, their free cash flow over the prior 12 months had actually topped $1 billion.
$1 billion in free cash flow. That gives them a lot of flexibility.
Immense flexibility. And they've managed their debt very prudently. It's mostly long-term debt with a weighted average maturity of about 13 years.
So they locked in lower rates and don't have big repayments coming due soon.
Exactly. It insulates them from the immediate impact of rising interest rates that are affecting other parts of the economy. Their key leverage ratio, debt to EBITDA, was sitting at a comfortable 2.2x in mid-2025.
In their target range.
Their target is 2.0x to 2.5x, so they're right in the middle of that comfort zone. This strong financial position gives them what they call dry powder, the capacity to make strategic acquisitions or fund heavy capital expenditures without putting stress on the company. #55. Growth strategy and capital allocation.
Okay, so they have this strong financial base, generating lots of cash. How do they decide where to put that money? What's the growth strategy and capital allocation plan? They seem to have two main pillars, enhancing the core and expanding the reach.
That's their framework. Enhancing the core is all about organic growth. It means reinvesting heavily back into their existing quarries and plants, applying the Vulcan way principles relentlessly to squeeze out more efficiency and maximize the profitability of the assets they already own.
Like that process intelligence system we talked about.
Exactly. It's a continuous loop of improvement, investing in better equipment, better logistics, better processes to drive those unit profits higher.
And this is a capital-intensive business, so that reinvestment must be substantial.
It really is. Their capital expenditure, or CapEx, guidance for 2025 was somewhere between $750 million and $800 million.
$750 to $800 million. How does that compare to their cash flow?
But remember, they generated $1.4 billion in operating cash in 2024. That CapEx budget represents something like 54% to 57% of that cash flow being plowed right back into the business.
Wow, over half. That's way higher than, say, a tech company.
Oh, vastly higher. This money goes into replacing aging haul trucks, crushers, screens, upgrading their rail capabilities, optimizing their distribution yards. And importantly, right now, it's also about expanding capacity and efficiency, specifically to handle that expected wave of IIJA volume.
So it's not just keeping the lights on, it's growth CapEx, investing for the future demand.
A significant portion is growth-oriented, yes. And linked to that is how they use pricing strategically, not just for today, but for tomorrow.
What do you mean?
Management was quite open about this. They said price increases they implemented in mid-2025 were specifically intended to create a positive tailwind for 26 pricing. They're layering in price increases strategically to build momentum for future profitability, years in advance.
That's thinking ahead. Okay, so that's organic growth. What about expanding the reach through M&A mergers and acquisitions?
This is their inorganic growth lever. But they emphasize being very disciplined here. They're not just buying up any quarry to get bigger.
What are they looking for?
They target specific acquisitions that either vault them into a #1 or #2 position in a local market they want to enter, or significantly strengthen their footprint in an existing high-growth region where they already operate. It's about strategic fit and market leadership.
We saw that with the big U.S. concrete deal back in 2021, right? That deepened their downstream integration.
That was a transformative deal. $1.29 billion. It gave them much bigger scale in ready-mix concrete in key markets like Texas and California.
And more recently, they've done smaller bolt-on deals.
Yes, in 2024, they made several targeted acquisitions. They bought Wakestone, strengthening their position in the fast-growing Carolinas market. They acquired Superior Ready Mix in Southern California. These deals often focus on securing those valuable, pre-permitted reserves near growing population centers, reinforcing that regulatory moat.
And underlying all this is a clear geographic strategy. They aren't trying to be everywhere, are they?
No, they're very deliberately concentrated, primarily in the Sunbelt states and key coastal markets. Their network serves 35 of the top 50 fastest-growing metropolitan areas in the U.S.
35 out of 50.
Yeah. Think about that. They are aligning their incredibly long-lived fixed assets, their quarries, with where people and businesses are moving. It creates this built-in, decades-long demographic tailwind for demand. People moving south and west need houses, roads, schools, all built with VMC's materials.
Okay, makes sense. So putting it all together, reinvesting in the core strategic M&A, where do shareholders fit into this picture? What's the capital allocation hierarchy?
It's very clear from their actions and commentary. Priority number 1 is organic reinvestment, that heavy CapEx spend. Priority number 2 is strategic M&A that fits their criteria. And priority number 3 is returning cash to shareholders.
Growth first, then returns.
Absolutely, which is reflected in their shareholder return program.
How so? Is the dividend small?
Relatively, yes. In 2024, they returned about $313 million, total $244 million through dividends, and only $69 million through share buybacks. Their dividend yield is typically quite low, around 0.6% or 0.7%.
That low yield confirms they're not managing the company for income investors.
No, the primary focus is clearly on reinvesting cash back into the business to drive future growth, either internally or through acquisitions. Share buybacks tend to be more opportunistic. They'll do them if M&A opportunities look thin or if they think their stock price is temporarily undervalued. But they won't sacrifice core investment for buybacks. #Tech6. Risks, valuation, and the investor debate.
Okay, so we have this picture of a high-quality business. Strong moats, disciplined management, focus on profitability, great positioning for infrastructure spending, which naturally leads to the market recognizing this. Let's talk valuation. VMC trades at a pretty significant premium, doesn't it?
It really does. The market isn't pricing VMC like a typical cyclical basic materials company. It's pricing it more like a premium industrial growth story. Historically, its trailing price to earnings, or PE, ratio often sits up around 42x, 43x.
42 times earnings. How does that stack up against its own history?
It's definitely on the high end. That kind of multiple is roughly 20–21% above its longer-term average, which has typically been more in the 35x to 37x range. So investors are paying significantly more for each dollar of Vulcan's earnings today than they have historically.
What's the justification for that premium?
It's basically a bet that the margin expansion they've achieved is sustainable, and that the IIJA volume growth is coming and will drive earnings much higher over the next several years. The market is pricing in that future growth.
How does it look compared to its main competitors?
The premium stands out there too. VMC's PE, around 42x, is noticeably higher than its closest large competitor, Martin Marietta Materials, which usually trades closer to 35x earnings.
Okay, still high, but a gap there.
Yeah, and significantly higher than other, maybe more regionally focused or less aggregates. Pure players like Eagle Materials, which might trade closer to 17x earnings. The market is clearly awarding VMC a premium for its specific combination of scale, geographic focus in high-growth areas, those deep reserves, and critically, its proven track record of execution that Vulcan way.
Yet, despite that premium, most Wall Street analysts seem to rate the stock a moderate buy, maybe not a strong buy. And their price targets, like you see around $308 in late 2025, often suggest the stock is maybe fairly valued already. Like, the good news is priced in.
That's often the consensus view, yes. It creates a dilemma for investors. To justify buying or holding at these elevated multiples, VMC basically needs to execute flawlessly. The expectations are very high.
Okay, so let's lay out the risks. What's the bear case? What could go wrong and justify not paying that premium?
Well, number one is always cyclicality. Despite their internal strengths, VMC is still tied to the construction cycle. If we hit a really severe, prolonged economic downturn, even the resilience of public spending might not be enough to offset a sharp drop in private construction demand.
So a deep recession is still the biggest external threat.
Always. Second, interest rates. Even if the Fed stops hiking or starts cutting, rates could stay elevated for a while, continuing to put a damper on private construction housing, commercial buildings, which are important end markets.
And reliance on government spending brings its own risks, right?
Absolutely. Political risk. Dependence on IIJA funding means they're exposed to potential political gridlock, budget fights, or just bureaucratic delays in getting projects approved and started. You hear about pavement delays where the money is allocated but doesn't turn into actual work quickly.
Okay, what about internal risks?
Input cost volatility is always there. Diesel fuel prices can swing wildly. Liquid asphalt, a key input for their asphalt segment, is tied to oil prices. Labor costs remain elevated. And given their active M&A strategy, there's always the risk that they overpay for an acquisition or struggle to integrate it smoothly. That U.S. concrete integration, for example, took focus and effort.
All right, that's a solid bear case. Now flip it. What's the bull case that justifies paying 42 times earnings?
It really rests on four main pillars, I think. First, those durable competitive moats, the scale, the local market dominance, the irreplaceable permitted reserves, the logistics advantage, high barriers to entry.
Okay, the structural advantages.
Second, the proven operational excellence of the Vulcan way. Their demonstrated ability to consistently expand unit profitability, that price over volume discipline, even in tough environments.
The execution track record.
Third, the visibility and scale of the IIJA tailwind. That multi-year funded demand provides a strong, predictable baseload of volume, especially in their key states. It de-risks the forecast somewhat.
The infrastructure catalyst.
And fourth, that exposure to newer secular growth trends, data centers, onshoring, grid upgrades. These provide potential upside beyond traditional construction cycles and diversify their demand sources over the long term.
Okay, strong arguments on both sides.
Yeah.
So if you're tracking VMC, trying to figure out if that premium valuation holds, what are the key things you absolutely need to monitor?
I'd focus on three main debaser factors. First, the actual pace of public spending. Forget the headlines about trillions allocated. Watch the State Department of Transportation budgets. Watch the highway contract award data. Is the IIJA money translating into real projects at the expected velocity? That's the volume story.
Got it. Track the real spending, not the promises. What's second?
Watch for signs of a trough in recovery in the private markets, especially housing. When do housing starts and building permits bottom out and start turning positive again? If private demand starts recovering while public spending is still accelerating, that's when you could see really powerful, broad-based volume growth kick in for VMC, leveraging those high margins.
The timing of the private market rebound. And third,
You absolutely have to keep your eye on that key metric. Aggregates cash gross profit per ton. Can they sustain the double-digit growth rate in unit profitability? They've benefited from strong pricing power, partly fueled by general inflation pass-through. As inflation potentially cools, can they still command 8%, 10%, 12% price increases year after year?
Or will that growth rate inevitably moderate?
Exactly. That metric is the clearest indicator of whether their core strategy is still firing on all cylinders. Any significant sustained deceleration in unit profit growth would be the biggest red flag for the bull case and the premium valuation. Hashtag tag outro.
Okay, so wrapping this all up, what's the main takeaway here? Vulcan Materials Company. The complexity isn't really in what they sell. It's rocks, sand, gravel. The real sophistication lies in how they manage the whole process. The pricing, the logistics, the operational efficiency, the strategic location.
So that's exactly. They've navigated this tricky period, shifting from what used to be maybe more of a volume-driven cyclical commodity business into something different, a margin compounding machine, really,
Yeah.
built on those strong geographic and regulatory moats, and perfectly positioned, it seems, for this big infrastructure cycle.
A high-quality business leveraged infrastructure with a proven ability to execute.
Right. But if we connect this to the bigger picture, and maybe leave you with a final thought to ponder, VMC's current high valuation demands near-perfect execution and assumes that transition from pure margin expansion to IIJA-driven volume growth happens smoothly. So the really interesting question for you as you think about this is that aggregates cash gross profit per ton. It's at a record high after years of strong growth. How much longer can that double-digit growth in unit pricing realistically continue before it naturally starts to plateau or normalize? History suggests pricing power isn't infinite.
Right.
And when that pricing lever becomes less potent, how much actual volume growth, remember that total volume is still 23% below the 2006 peak, is truly needed to keep driving earnings momentum forward and justify that premium valuation. That gap between peak volume and current volume, fueled by IIJA and maybe private recovery, that's the ultimate leverage they're aiming to capture. What happens when that pricing power normalizes and the volume story has to carry the load? That's the key question going forward.